Have you ever dreamed of building real life-changing wealth? Owning a six-figure portfolio might seem like a lofty goal or something only the rich can achieve. But here's the truth. With the right strategy and a little discipline, it's within reach of everyday investors. Whether you're starting with $100 or $10,000, I'll show you how to build a $100,000 portfolio using SCHD and its friends to help you get there faster. At the core of our strategy lies a true heavyweight in the investing world, SCHD. The Swap US Dividend Equity ETF isn't just another fund. It's one of the most efficient tools for building long-term wealth. Here is the secret sauce: low expense ratio. Unlike some funds that charge high fees to manage your money, SCHD keeps costs incredibly low, charging just 0.06% annually. That's pennies on every $1,000 you invest, ensuring more of your returns stay in your pocket. Focus on quality. SCHD invests in a select group of companies with strong financials, consistent dividend growth, and a history of rewarding shareholders. These are businesses like Johnson & Johnson, Microsoft, and PepsiCo, which are known for their stability even in tough markets. While it's a dividend-focused fund, it isn't just about income. SCHD also delivers competitive capital appreciation. The fund has consistently delivered returns comparable to and sometimes better than the broader market. Think of SCHD as your portfolio's engine, reliable, efficient, and built for the long haul. It doesn't just generate dividend, it grows with you over time. It's the perfect mix of stability, income, and growth. No successful portfolio relies on just one asset. While SCHD is your foundation, and a fantastic one at that, diversification is what protects your portfolio during market ups and downs. By adding complementary investments, you reduce risk and capture opportunities across different markets. Consider allocating 20 to 30% of your funds into growth stocks. Tech-heavy ETFs like the Qs and VUG focus on companies pushing innovation forward. Think Apple, Amazon, and Tesla. These are riskier, but their potential for outsized returns balances SCHD's steadiness. Then you can have 10 to 15% in international stocks. Why limit yourself to the US? Funds like VXUS and VYMI allow you to diversify globally and give you access to growth in international markets from Europe to emerging economies in Asia. You can have 5 to 10% in small cap stocks like IWM and VB. Small cap companies are often young and rapidly expanding, which can lead to significant growth, but with added risk. A small allocation here can supercharge your returns during bull markets. And finally, bonds provide stability, acting as a buffer protecting your portfolio during market downturns. Putting 5 to 10% in bond ETFs like BND and TLT is a good idea, as bonds often hold steady or even rise when the stock market dips. By diversifying, you're not putting all of your eggs in one basket. You're building a system designed to handle any market condition, ensuring that when one segment stumbles, others can pick up the slack. Now let's talk about the secret ingredient that makes your portfolio grow exponentially: compounding. When you reinvest the dividends from SCHD and other funds, those dividends start earning dividends of their own. Over time, this creates a snowball effect that turns your modest investments into life-changing wealth. Just so you understand how powerful this is, consider an investment of $10,000 in SCHD with an average return of 7% annually where the dividends are reinvested. After 20 years, it grows to over $38,000 without adding a single extra dollar. If you were to make monthly contributions of $500, after 20 years, you'd have over $260,000, of which $140,000 is from growth and reinvested dividend. As you can see, the key to compounding is time. The earlier you start, the more powerful the effect becomes. This is why time in the market beats timing the market. Consistency is where most investors fall short. But here's the good news. You don't have to be perfect. You just need to be consistent. By automating your investments, you can stay on track without worrying about timing the market. Let's say you contribute $500 per month to this diversified portfolio. At an average return of 7%, you will reach $100,000 in just over 11 years. Increase that to $750, and you are there in under 9 years. It's that simple. This is called dollar cost averaging. It ensures you're not trying to predict the market. It's a simple, stress-free way to keep investing no matter what. And don't forget to rebalance. As your portfolio grows, some investment will outperform others. Rebalancing keeps your asset allocation in line with your long-term goals. Reaching $100,000 is more than just a number. It's the first step towards financial independence. It gives you option, freedom, and the peace of mind that your money is working for you, not the other way around. Remember, this isn't about getting rich overnight. It's about building lasting wealth one step at a time. And you've already taken the first step by watching this video. Now it's your turn. What's your first step towards building your $100,000 portfolio? Let me know in the comments below. And if you found this video helpful, hit that like button, subscribe, and share this with someone who needs to start their investment journey today. Until next time, stay financially savvy. I'll see you in the next one.